Hello everyone, today we're solving question 2 from the fall 2014 COMM 217 midterm examination. And this question has to do with long-lived assets. It's 19 marks for 31 minutes. Okay, so let's just get an overview of what this question is all about. So it's a question about long-lived assets, so we're going to probably have an acquisition, some depreciation to record, possibly a change in estimates, and possibly a disposal, which is the normal cycle of a long-term asset. We buy it, we use it, we change estimates sometimes. Sometimes there could be an impairment, and at the end of its useful life, it's either retired or disposed. Okay, so that's the normal life cycle for an asset. So let's take a look at what's going on in COMM Company. So on July 2011, okay, they purchased some assets, land, building, and equipment for $5.5 million. And they paid half in cash and the other half with a 2-year note. There's 5% interest on the note, and both are due in maturity. Fair market value is for the land, building, and equipment is given here. 1, 2, 3. Okay. And the company also paid $180,000 in legal fees, $220, and $100 for appraisal fees. Okay, so this is information that we're going to need that's going to be very helpful to determine the cost of the asset. Okay, what do we set up as an asset? What gets capitalized and what gets expensed? Okay, and just moving on, then we're given some information about the building and the equipment. Okay, the first 2 bullet points are information about the life of the asset, the residual value, and this is going to be helpful to us to determine the amount of depreciation to take each year. Okay, and then we move on for a couple of years. Right now we're up to 2014, and they give us some information about some additional costs that were incurred to decorate the building and to engage in a major improvement of the building. Okay, so this is information that's going to be helpful for us to determine the changes in estimates. Okay, so in this bullet point, the third one, the company invested some money which changed in this case, the useful life and the residual value of the building. And finally, this is a sale of the asset for $2.5 million. And we're told that the fiscal year ends June 30th. Okay, so again, this is a typical demonstration of the cycle of an asset. We acquire it, we depreciate it, we change things perhaps, not all the time, but sometimes, very often. We have changes in estimates, we spend money to improve a building, and then we sell it. So we're going we're experiencing the cycle at its fullest here. So the one way to do this question is to understand what is going on. Okay, so and the best thing to do this is a timeline. Okay, because this story starts in 2011 and it ends in 2015. So at the beginning of the story, which is July 1, 2011. We bought land, building, and equipment. Okay, and we paid cash. The total price was $5.5 million, but the cash paid was half, so that's $2,750,000. And the rest would pay with the note payable for the other half. And this is a 5% 2-year note, which is due at maturity. Both the principal and the interest are due at maturity. Okay. The other thing that happened on July 1st, we incurred some other costs to prepare the asset for use. So we paid a total of $180 plus $220 plus $100. So this is equal to $500,000. $500,000. Okay, this is what happened July 1st. We bought some land, building, and equipment for $5.5 million, paid half in cash, half in a note payable, and we spent another $500,000 in cash for other costs in order to prepare the assets for use. Okay, so then let's continue. We have our first year end, okay, which is June 30th, 2012, okay, and then we have another year end, June 30th, 2013, and then we have another year end, June 30th, 2014, and then the very last point on this timeline is January 1, 2015. Okay, so let's just go back to the beginning again. So we acquired everything July 1st, 2011. Nothing happened. So at the end of the first year, we have to compute depreciation. And another year goes by. We have to compute depreciation. Okay, and let's go back to the question again. So, so we're here now. On January 1, 2014, the company started to renovate the building, and they paid $120 for new decoration of office, for new decorations for the office, and they paid $400,000 to make major improvements. Okay, so this $120, okay, is simply an expense in the year. This is not going to add to the value of the building in any way, its useful life or its residual value. It's just decoration. So this does not get capitalized. It's simply an expense on the income statement for that year. This $400,000, okay, is going to be capitalized because it increases the building's useful life and the residual value. So it's what we call a major improvement to a building, and this $400,000 gets capitalized. So we're told that the renovation on the building was completed by June 2014. Okay, so this is, in other words, an asset that was acquired, not acquired, but an asset in construction. Okay, so this $400,000 needs to be added to the cost of the building at the end of 2014, June 30th, or at the beginning of 2015, which is July 1st. Okay, so at the end of 2014, we could say we acquired, okay, or constructed an asset for $400,000. Okay, and this is added to the cost of the building. And 6 months later, we're told we sold the building for $2.5 million. Okay, so this is the story, okay, that will help us answer this question. So let's get to the first required. Identify the expenses, both type and amount, that the company would report on its statement of earnings for the year ended June 30th, 2012. Okay, so June 30th, 2012, okay, this is required number 1. Okay, so what happened between, for this year? Okay, so this is the period in question that we need to consider in order to answer required number 1. So if you just look at what happened, okay, we bought something, we paid half cash, half with a note, okay, so we are going to incur some interest, and we're going to compute some depreciation for the year. So what happened during 2011, what affects the income statement is we're going to have some depreciation expense, and we're going to have some interest expense. Okay. Remember, they're asking us the effects on the statement of earnings or the income statement. Okay, so they're not asking about the balance sheet or the statement of financial position or the statement of cash flow. They're asking you what we're going to see on the statement of earnings as a result of this transaction that happened on July 1st, 2011, the purchase of these assets and the incurrence of a note payable. So the first thing we have to do is let's deal with depreciation expense. So the amount of depreciation that would have been recorded on this statement of earnings for the period ended June 30th, 2012 would have been the following. Okay, so we need to compute the depreciation for the assets that we purchased. So we purchased land, building, and equipment. Okay, so the first thing we need to do is allocate the $5.5 million to these individual assets. So this is, again, a basket purchase. And how do we allocate the $6 million? Well, we allocate it based on the relative fair market value. So the fair market value of the land is $1,750,000, the building $2,800, equipment $2,450, and that totals $7 million. So I'm going to take this, just divide this by 7 million, 7 million, 7 million, and multiply this by 6 million. Okay, so that gives me a cost of $1,500 for the land, $2,400 for the building, $2,100 for the equipment. So $6 million. Okay, and just let me backtrack how I got to this $6 million. Okay, this $6 million is equal to the purchase price plus the other costs to prepare the asset for use. Okay, so in our case, our purchase price was $5.5 million. And the other cost is this $500,000 here. So again, these are costs that were necessary to prepare the asset for use. In other words, if we didn't spend this money, we wouldn't be able to use the asset. So we have to add that. This amount gets capitalized as part of the cost of the purchase. So we're looking at $6 million. Okay, so that explains this number here. Okay, so let's compute the depreciation for the building. Okay, so for the building, they're using the straight line method. Okay, and we all know that is cost minus residual value over useful life. Okay, so the cost initially is $2,400 minus the residual value, which we're told is $150,000 and 10 years useful life. So $150K over 10 years. So that gives me $225,000 per year. And the equipment, we're told it's double declining balance. Okay, so accelerated depreciation, and we know that double declining is 2 times the straight line rate. Okay, so let's just take a look at what they're telling us about the equipment. The useful life is 4 years. Estimated salvage value is $300,000. Okay, so let's figure out, first of all, what the rate is. Okay, so we're told it's 2 times the straight line rate. Well, how do we figure this out? Well, they say the useful life is 4 years. Okay, that means you would depreciate at the rate of 25, oops, let me just fix that, of 25% per year. Right? If you have 4 years, you're depreciating an asset over 4 years, you're depreciating it at the rate of 1/4 or 25% of the year. Okay, if this was 5 years, you would be depreciating at the rate of 20%. If this was 10 years, you'd be depreciating at 10%. It's like at 5 years, as I said before, you'd be depreciating it at 20%. Okay, so 4 years gives us a rate of 25%. Therefore, double declining balance is equal to 50%. 2 times the straight line rate gives us a rate of 50%. Okay, so the depreciation in the first year for the building would be, as we all know, the double declining balance method is computed as the carrying value times the rate. Okay, so the depreciation in our case would be our carrying value at the beginning is $2,100,000. This is the carrying value, and it's also the cost because this is the first year that we're depreciating this equipment. So the carrying value is equal to the cost. Again, next year this certainly won't be the case because we will have depreciated this equipment for 1 year. But for the first year, the initial year of depreciation, the carrying value is also equal to the cost. So we're going to take this 22.1 million multiplied by our double declining rate, and we're going to get 1,050,050 depreciation for the first year. Okay, so the land doesn't depreciate, so there won't be any depreciation incurred on the first year regarding this purchase. So the other item that will affect the income statement for the first year is this note payable. Okay, remember we issued a note payable for $2,750,000. So the effect that that's going to have on the income statement is that we're going to have interest expense. Okay, remember, even though we don't pay interest expense, if we've incurred it, we need to record it in the year we had use of the money. So for this interest expense, it relates to the note that we issued, which is $2,750,000. This is the face value of the note payable, and we have 5% interest, and we had it for a whole year, so 12 over 12. So the interest that we're going to be showing on the income statement, okay, is $137,500. And just to remind you of what this would look like on in terms of journal entries, this is what we would be doing at the end of the year. Booking interest expense, and even though we haven't paid it yet, but we need to record the fact that we've incurred it, so the corresponding credit is going to be interest payable. Okay, so the answer to question A, okay, the effect of the, let's go back to actually read it, okay. Identify the expenses that Sam Company would report on its statement of earnings for the year June 30th, 2012, so the first year after the date of acquisition. So the answer to this is they would be recording depreciation of $225,000 on the income statement. They would be recording depreciation of $1,050,000 for the equipment and recording interest expense on the income statement of $137,500. Okay, this all relates to the purchase on July 1st, 2011. Okay, so we've completed requirement number 1. So let's go to requirement number 2, which is show how the purchase transaction and the related adjustments would be presented on a partial statement of cash flow for the year ended June 30th, 2012. Okay, so we're still at the first year end after the acquisition of the 3 assets, and they're asking us how this is going to be shown on the statement of cash flow for June 30th, 2012. Okay, so what I'm going to do here, okay, is Okay, and the important thing to get here is that they are using the indirect method of computing cash flow from operating activities. Okay, so the indirect method versus the direct method only affects how you compute cash flows from operating activities. So we're using the indirect method. So we know the statement of cash flow has 3 sections on it: operating, investing, and financing. Okay, we're going to have the name of the company here, the date, etc. So how would this affect my operating section? Okay, well, we would, first of all, let's deal with the depreciation. Okay, so we would have, with the indirect method, we always start off with net income, some amount, and we try to adjust this final amount for any things that affect cash. Okay, so one of the first things we do is we add back the depreciation. And we have the depreciation on the building and the equipment. Okay, so the depreciation on the building is $225, and the depreciation on the equipment is $1,050,000. Okay, this is not a non-cash expense. Okay, and if you remember what depreciation is about, it's the allocation of a cost that was incurred, in a prior period to the future periods that are going to benefit from this. In other words, we are not paying anyone $225,000 or $1,050,000 for depreciation. This is simply an allocation of a prior cost to a future period. Okay, so it's a non-cash expense. Okay, the other thing we would do if we're using the indirect method is that we would add back $137,000. This is the change in interest payable. Okay, because this is not yet paid in cash. Okay, and we saw that here. If you look at the journal entry I made, we have an expense on our income statement, but we increased our payable. So this was not paid in cash, which means that the income here, this income includes $137,000, okay, that was not paid in cash. That's why we have to add it back. Any increases in liabilities, in your current liabilities, need to be added back because it means you've incurred an expense and you haven't yet paid it from a cash point of view. In terms of investing, we're going to see something, purchase of land, building, and equipment for $3,250,000. Okay, and what is this? This is it's half of the $5.5 million we paid for the in cash, plus the $500,000 we paid in cash for the to pay for the costs that were necessary to incur to prepare the assets for use. So this totals $500,000. So we have to add that. So this affects my investing activities. Remember, this is half of the $5.5 million plus the $500,000. For the financing activities, we're not going to see anything. Okay, so this is the answer to required number 2. So for required number 3, they're asking us to prepare the journal entries for the disposal on January 1, 2015. Okay, so we're looking ahead 3 years here. Okay, so let's go back to our timeline, okay, and see what they are asking us to do. So they are asking us to prepare journal entries on this date, which is not the end of the year, but it's 6 months after the last year end, to record the sale of the building. Okay, so in order to answer this required, okay, this required is basically a disposal. Okay, and to record a disposal, we need to know the carrying value of the asset. Okay, and this is also called your net book value. Okay, and it's computed as your cost, okay, your initial cost, minus all of your accumulated depreciation over the years. Okay, so this is everything from, in our case, July 1st to January 1, 2015. Okay, so all the depreciation taken over these years related to this asset. Okay, and what we're disposing of is the building. Okay, so let's go back and see how we can do this. Okay, so let's go back and determine what the original cost of the building was. Remember, it was $2.4 million. Okay, so that's our starting point. So the cost that we capitalized on July 1, 2011, okay, was $2.4 million. Just to show it another way, I'm going to use T accounts. Okay, so on July 1st, we would have debited building, $2.4 million, credited cash, credited note payable, but we have for sure a debit here in this account. Okay, let's go back to the timeline. So for the year ended June 30th, okay, we would have recorded depreciation. So depreciation for the year ended July 2012, and we know that's $225,000. Depreciation for year ending July 2013, that's $225,000. Okay, let's go back to the timeline. So we're here, nothing has happened. We acquire the asset, we depreciate it at the end of 2013. At the end of 2014, okay, we will have depreciated it again. Okay, and this is based, this is what is happening this year. Okay, so we have 1, 2, 3 periods that have gone by, okay, up until June 30th, 2014. Okay, and that's exactly what I have, 3 periods here. Remember, with the building, we spent $400,000, okay, to renovate it, and the renovations were complete on June 30th, 2014. So here I'm going to put renos of $400,000, okay, completed June 30th, 2014. Okay, so on June 30th, okay, so this is depreciation for 2014. On the same day, okay, we invested, okay, acquisition, or these are renos, another $400,000 in the building. Okay, so these are all deducted. This reduces the cost of the building. This is added back or capitalized to the asset. To the asset. Okay, so at this point, we've got a cost, we've got some depreciation, we've added back $400,000, and this brings us to the end of 2014, June 30th, 2014. Okay, what happens 6 months later, January 1, okay, the building gets sold. Okay, so what we need to do in order to prepare the journal entry at January 1, is to figure out the carrying value of the building at January 1. Okay, so what we need to do, in order to do that, we need to record depreciation for 6 months. Okay, and this is, once we do this, okay, this will be the carrying value of the building at January 1, 2015 on the date of sale. Okay, so again, we need to record the depreciation for 6 months from July 1st, 2014 to January 1, 2015. Okay, so, hello, so these $400,000 of renos were completed June 30th. So what we've done here is, you can see we've added it to the cost of the building. Okay, so at this point, okay, the carrying value of the building July 1st, 2015, the new fiscal year, is simply the sum of all this. So 2.4 million, all the depreciation we've taken, the additional renos added to the cost base of the building. So that gives us a new cost base of $2,125,000. Okay, so this depreciation that we're going to need to record for 6 months is going to be based on this new carrying amount. So let's compute what the depreciation would be for 6 months from July 1st, 2014 to January 1, 2015. So our new cost base is $2,125,000, which we just computed here, and minus the residual value. Okay, so we are told that the original residual value was $150,000, and that these renovations increase the residual value by $100,000. Okay, so the new residual value is $250,000. Okay, so this is the new RV, which is equal to $150K plus the increase in residual value as a result of the renovations. Okay, so this is divided over the new useful life at this time. So what we're talking about, we originally had a 10-year useful life. So, okay, this was the original. And we're told that it's going to increase the useful life of the building. These renos are going to increase the useful life of the building by another 3 years. But we have to remember that we've already used or depreciated the building for 3 years. Okay, so the net effect of this is $187,500. Okay, so let me just make that a bit neater. Okay, and this would be the full year of depreciation that we would take if we kept the building and not sold it. So if we were doing this for the following year, we would have recorded this much depreciation. So this is for a full year. But what happened in this case is we sold the building 6 months later. So we have to, first of all, bring the depreciation up to date, and that's exactly what we're doing here. And then compute the gain or the loss. So the depreciation for 6 months, we just computed it here, would be $93,750. Okay, so the carrying value, okay, the carrying value on the date of sale would be $2,125,000 less $93,750. So our carrying amount that we're going to use to compute the gain or loss on the sale is $2,031,250. Okay, so now we have everything we need. And let's go back to the required to see what they are asking for again. Journal entries to record the disposal on the building. Okay, so required number 3. Okay, so just for learning purposes, I'm going to recreate our T accounts. Okay, and the accumulated depreciation on the building. So quickly, we know we bought it for $2.4 million, and we depreciated it for 3 years at $225,000. Oops, sorry. $225 for year 1, $220. No, sorry, my mistake. Apologize for that. The accumulated depreciation is recorded in a separate account, so we would have had $225,000 for the first year, $225,000 for the second year, $225,000 for the third year, and you see that that's exactly what we did. And in the last 6 months, we changed the depreciation method, and we only booked 6 months because we sold the building. So the total accumulated depreciation in our case would be $768,750. Remember, the other thing that affected this account was the $400,000 of renovation costs. Okay, and that if you remember, we capitalized to the asset, so that increased our cost of the building. Okay, so this is what we're sitting at January 1. Okay, so the first thing you have to do, okay, is to record the cash. Okay, so we received cash. The second thing you have to do, you have to remove the asset from the books. Okay, why? Because you no longer own it. Somebody else owns it. Right, you've sold it. So remember, the definition of an asset is something that you own and that has future economic value. Well, you don't own this asset anymore because you've sold it. Okay? In other words, you've exchanged one asset for another. So you've exchanged one asset, which is the building, for another. What's that other asset? It's called cash. Okay, so if there's a difference between the book value of the building and the book value of cash, that will lead to a gain or loss. So let's first of all record the cash. So we're going to do something like this, right? This is debit, credit. We're going to debit our cash for $2.5 million. So that's where we're getting in. What are we giving up? Well, the building. So since we no longer own it, we have to remove it. We have to remove both the building and any accumulated depreciation from our books. So how do you remove $2.8 million? Well, you credit this, $2.8 million, and that gets rid of this. We have to get rid of our accumulated depreciation, and this is a credit, so how do you get rid of it? You debit it. $768,750. Okay, so that gets rid of that, and there's a difference here. So you need a plug. So what we need to do is determine what number we need here to make this entry balance. Okay, so you'll see that what we need here is a plug of $468,750. Okay, and this credit is a gain on disposal. Okay, so another way you could do this is say you received cash of $2.5 million, and what is the book value or the carrying value, or the net book value or the carrying value of the building? Okay, well, the net book carrying value of the building is $2.8 million minus the accumulated depreciation on the date of sale. Okay. And if you do that, just let me do that for a second. Minus $768,750. So the book value is $2,031,250. Okay, so you can see right here that you're getting cash in of $2.5 million. What are you giving up? Well, something worth $2,031,250. So you're getting more cash than what the net book value of the building is. So this means you have a gain on disposal. Okay, and that's in fact what we're recording here. Okay, so thank you very much and good luck.